So what Vinny had just talked about, 100% of what you invest in oil and gas, you're able to go directly against your AGI. And the reason for that, I know, Vinny had brought up cost segregation with real estate. With oil and gas, there's a different terminology called IDCs or intangible drilling costs. That was a Ronald Reagan bill that was passed that allows you to go against active income, passive income, as well as capital gains. And year one, you're able to capture a majority of this deduction. We have averaged 85% the last 3 years, which has been terrific. And then the second option is we do pay monthly revenue as well. As our wells are generating commercial amounts of hydrocarbons, we pay that out to the partners and about 9 to 14%. But really what makes our program special, I mean, this is kind of the difference maker between us and all of the other companies that are out there, is that we look for a divestiture at the end within 3 to 5 years. And this is where we're targeting a 2.3x when we do divest and sell those assets. But I know on this, I really want to just stick to the tax portion of it. I did want to kind of describe the full part, but so that brings me to right here, which is kind of gives a little bit more detail on how the tax benefit works. So just an example, like for instance, with Vinny on a $200,000 investment, you're able to reduce 150. Now we use a deduction factor of 75% because in 26 years we've never not hit this target. But we have averaged 85% the last 3 years. So I typically like to tell investors 80 to 90, or I'm sorry, yeah, 80 to 90% is where you can aim for. And if you are in the highest tax bracket, that gives you about a 30% return right from the get-go, or allows you to save roughly $60,000 against active income, which there really, I mean, Vinny, you can attest, there really isn't anything out there in the market that does that.